Hi everyone, welcome to Peschu's Corner. Today I want to talk about tax incidence. Tax incidence is the burden that falls from the tax, and usually this burden is shared by the consumers and the producers. So the outline for today's lesson will be to briefly define tax incidence, then we'll learn how to draw it and to illustrate the burden on the producers and on the consumers. And finally, we'll do a simple mathematical example where we are going to calculate the tax incidence. So let's start first with the definition. And the definition of tax incidence is precisely the burden of the tax on either the consumer or the producer. Thus, we are going to have a consumer tax incidence, which is, as we said, the burden of the tax on the consumer. And similarly, we can have the producer tax incidence. So which is the burden of the tax on the producer this time. Now, these burdens do not need to be shared evenly. Sometimes the consumers will pay a bigger proportion of the tax, and in other times it will be the producers who will do so. So let's have a look at a graphical example. We'll use a diagram and then we'll be able to talk more about this. Okay, so we are going to start with a standard diagram of price and quantity. And let's have a market that's in equilibrium, supply and demand. This will be D0, this will be S0, and this is our original equilibrium point, E0. The equilibrium price is PE, the equilibrium quantity would be QE. An indirect tax or an expenditure tax will decrease our supply. And to make things somewhat easier, we'll assume that the tax would be a specific tax, which is also called a unit tax. So we have T is a specific tax. And we'll have a parallel shift to the left of the supply curve when we levy this tax. So this would be, I try to make it parallel, it's not perfect, but just assume that S0 and S1 are the two supply curves, and this is equal to S0 after T, so when the tax is placed. And the level of our tax would be this much. T, and T is constant at all price levels. So what is going to happen is that when we generate the new supply curve S1, we're moving the equilibrium point from E0 to E1. And at E1 we have a new price PE1 and a new quantity QE1. Obviously, because of the tax, the quantity sold on this market has declined and the price has increased. Okay, let's start first by showing the total tax revenue that the government is going to collect. If you remember, we already said that the vertical difference between S0 and S1 will be equal to our tax. So this T is identical to this T over here. The two of them should be equal. And while the consumers are paying PE1, the producers are actually going to receive, let's call it P1. So the price for the producers. And we can compare the two prices before and after to see how the producers were affected and how the consumers were affected. The consumers were paying the original price PE, and now they're paying the higher price PE1. So if this rectangle is the total tax revenue PE1, let's say PE1, E1, let me call this point point C. PE1, E1, C, and PP1. Okay, so this rectangle is our tax revenue that the government collects. I already went over this in another lesson, but it's simply this is equal to the QE1 times the T. It's the area of this rectangle, which is equal to the site, which is from 0 to QE1 times T the tax. And the portion of the tax that is being paid by the consumers would be this upper rectangle. Again, the reason for that is because the consumers are paying the now new higher price, and so the share of the tax carried by them is this difference between PE and PE1. On the other hand, the producers are receiving a lower price than they used to. The original price that they received was PE, and the new price that they're receiving is PP1. And thus, this lower rectangle represents the burden or the incidence of the producers. So we can say this is the producer incidence of the tax, and the green one is our consumer incidence. And if you notice, the sum of the two areas, the green stuff plus the blue one, if you sum this up, you get the total tax revenue collected by the government. So this is tax revenue. And graphically, this is all there is to it, really. We have the old price, the new price, and how much the firms producing the good are actually receiving. What we are going to do next is we'll use a simple mathematical example with straight line demand curves and supply curves, just to see how we can calculate the value of the tax revenue and the burden for the producers and for the consumers. To calculate the incidence of the tax, we are going to need a demand function and a supply function. So let's use two equations. The equation of the demand function would be equal as Q quantity demanded is equal to 50 minus 2P. Notice the negative coefficient of the in front of the price signifies that the relationship between the price and the quantity demanded is negative, meaning that as the law of demand stated, an increase in the price would lead to a decrease in the quantity demanded. And then we'll have a supply equation. So the quantity supplied would be equal to, let's say, minus 10 plus P. Again, a very simple example, just to show you how to calculate the tax incidence. The positive coefficient signifies that we have an upward sloping supply curve, which is again proved by the law of supply. We are going to need a tax, and the tax would be equal to, let's say, $1 per unit. So $1 per unit. And right, let's solve this. So to solve this, it's good to see where the old equilibrium was. So the old equilibrium would be, we have to equate supply and demand. So you have quantity demanded is equal to quantity supplied. And what this means is that 50 minus 2p is equal to minus 10 plus p. So for p, so we are going to have that 60 is equal to 3 times p, or that the price is equal to 60 divided by 3, which is 20. And since we're dealing with dollars, it will be $20. Now we can calculate the quantity. So the quantity would be equal to, we can substitute this 20 in either of the two equations. So 50 minus 2 times 20 is equal to 10. Let's say the quantity may be in thousands. So P is in dollars and Q is in thousands. And what I'm going to do is, on the left side here, I will be illustrating the outcome of our calculation. So price quantity, we say the quantity is in thousands, the price is in dollars, and our equilibrium happens at the price of 20 with a quantity. So let's say this is 20, or let's say we have 10. Wait, did I get this right? Price 20, quantity 10, yep. And if we want to draw it to scale, when the price is 0, quantity demanded will be equal to 50. Okay, so this is not a perfect to scale example, but hopefully you get the idea. Let's say this is where 50 will be, and connecting these 2 points like that. This will be our demand. And when, let's say, if the price would be 10, the quantity supplied would be 0, according to this equation. So let's say over here we'll have a 10. And connecting these. Okay, this is my original supply. S0. Now, we want to calculate what happens to this market once the tax is placed. And to do this, we'll need to modify the supply equation. Okay, so what we have to do next is we need to calculate a new supply equation, one which will take into consideration this new tax, in order to be able to figure out where the new equilibrium will be. We can mark this as E0, the old equilibrium. So I'll need some space. I'll get rid of these calculations. And now I'll be calculating the new equilibrium. The first thing that we will have to do is get the new supply. And the new supply would be equal to the old supply minus the tax. Now, the reason why we put the negative sign in front of the tax is because we do want to decrease the supply. The tax will have a negative effect on the supply curve. So the new supply would be equal to QS is equal to minus 10 plus P. And what we'll have to do now is say minus 1. This one comes from the tax, and again, we have a negative sign because we want to decrease the supply. So if we do this, we can simplify it as if it will be equal to minus 11 plus P. Okay, this is our new supply. The old one was minus 10 plus P. The new one is minus 11 plus P. Now to find the new equilibrium point, we simply use this new supply with the old demand, and that will give us the equilibrium point. So minus 11 plus P is equal to, 50 minus 2P. And if we solve for P, we'll get that 3P is equal to 61. And from here we can see that P would be equal to 61 divided by 3, that would be $20.33. Okay, so this is the new price. Let me just say this. And the new quantity would be 50 minus 2 times 20.33, which is going to be 9.34, if my calculation is accurate. Okay, so finding these points, let's say this would be 9.34. 20, was it 20.33? If we want to draw the new supply, minus 11 plus P, the new supply would be equal to a parallel version of S0. It's just there will be a vertical difference between them equal to 1. So if we start from 11, which will be approximately here, let's say, and we just want to go to this point, this. So this would be S1, and the distance between S0 and S1 would always be equal to $1. That's the idea of the specific tax. T is equal to 1 at any point. T is equal to 1. So now, what will be the price that the producers will be receiving? That's easy. If the consumers are paying 20.33, then we can subtract $1, which is the tax from 20.33. So the price received by the producers is equal to 19.33. So it's 20.33 minus 1, which is 19.33. And we can draw this. We can fill the two shade areas. This is the consumer incidence. And the bottom area would represent the producer incidence. We can also calculate the total amount of the tax paid by the consumers and the one paid by the producers. Actually, I'll use a calculator just to make sure that my calculations will be accurate. But if we want to find the total consumer incidence, that would be equal to 0.33, which is the difference between the old price and the new price that the consumers are paying, times 9.34. So if 9.34 divided by 0.33, so the consumer incidence in total would be 28.30. So this is equal to 0.33. Wait, I don't think I got this correctly. 0.33 0.33 times 9.34. Okay, so 0.33 times 9.34, and we'll get 3.08. 3.08. So that's obviously, since we're dealing with units in thousands, that would be times 1000. So we multiply this, and we get 3082 approximately. And if we want to do the same for the producers, let's get the green color. It would be the remaining 67 cents that the producers are paying from the tax. So that's the difference between 20 and 19.33. Remember, this was 19.33. Obviously, this diagram is not drawn to scale, guys. I can break the axis here like this and like that, just to illustrate that we are not to scale. But to calculate the amount of the tax paid by the producers, we'll do 0.67 times 9.34 times 1000, again to take into consideration the units, and this would be 6,258. So this will approximately be 6,258. And if we sum these up, we get that the total tax collected by the government would be equal to 3,082 plus 6,258, which would be, again, let me just use a calculator to make sure I don't make a fool of myself. 903.40, which actually makes sense, because another easier way to calculate our tax would be if we simply do this. 9 times 34 times 1, which is the tax. These are how many units, times 1000, and we get 9,340. So we can get the tax revenue simply by calculating the amount of quantity times the tax, or we can do it in this slightly more complicated way when we went and calculated the consumer incidence and the producer incidence. Finally, sometimes we may be interested to know what percentage of the tax was paid by the consumers and what percentage of the tax was paid by the producers. And we can do this again. It's with a simple math. The consumer incidence is a percentage, so percentage of tax paid by the consumers would be the easiest way to do this would be to see how much the price increased. The price increased by 33 cents. So 33.33 divided by 1, which is the total tax. Effectively, this is equal to 1/3. So the consumers paid 1/3 of the total tax, or 33% if we want it as a percentage, and the producers paid well, the remaining 2/3. The producers paid 2/3 of tax, which is equal to approximately 67%. All right, well, this diagram has a lot of things. Make sure that if you have questions, you can watch it again. Notice how I've been doing these calculations. You can, of course, ask questions in the comment section, so I'll try to answer them. If you like this video, please hit the like button. If you want, you can subscribe to the channel. And I will probably do another video which will show how this ratio of the tax incidence between the consumers and the producer changes depending on the price elasticity of demand and price elasticity of supply, of the demand and supply. All right, guys, well, that's it for me for this lesson. I hope you liked it, and I hope to see you again. Take care.